Good afternoon and welcome to the Switzer Report July webinar. I'm Paul Rickard. I'll shortly be joined by the illustrious Peter Switzer, but our special guest today is Tony Featherston. Tony, of course, is formerly the editor of Shares Magazine and has been a contributor and a star contributor for the Switzer Report for some years now. Tony, welcome, Tony Featherston. How are you?
I'm very well, Paul. Thanks for having me.
Tony's joining us from Melbourne. I'm in Sydney, and Peter Switzer is just running a little late. He'll be joining us from Blackheath and the Blue Mountains in New South Wales shortly. But great to have you on board, Tony. We look forward to your contributions during this webinar. Now, just before we start the webinar, a few housekeeping matters. The first one and most important is the obligatory disclaimer, which basically says that we don't know anything about your personal situation, individual needs, financial objectives, or actual investment objectives. So while we think we're going to give you some brilliant financial education, we don't really know whether it's appropriate or suitable for you or not. And so, as we always say, before acting on any suggestions we make, you should seek the appropriate professional advice. So important to understand that. I mean, different people have different objectives, different needs. What might be suitable for one person may not be suitable for you. So that's the important and obligatory disclaimer up front. Now, also, this is an interactive webinar. We've got a whole lot of questions to get to that many of you have sent in already, and we'll come to those shortly. But this also, we will be taking questions during the webinar, and there are some instructions there. So the first thing, if you want to ask a question during the webinar, you click on the raise your hand button to ask your question using a microphone. So most laptops have an inbuilt microphone. When requested, you'll need to click on the unmute button on your screen and we'll nominate you for that question. Or you can use the box at the bottom of the screen and you can type in your question on the Q&A box at the bottom of your screen. So hopefully you've got two options there on the Zoom. You've got raise your hand or Q&A. Raise your hand, you speak. Q&A, you type, and hopefully we'll be able to get to some of those questions as well. So it is interactive, and just from the timing sense, it's just after 12:30 p.m. Eastern Standard Time. We'll make sure we finish no later than 1:30 p.m. We understand that many of you have other commitments, and so we like to keep these timings pretty precise. Of course, the webinar, you'll be able to go back to our website, switzer.com.au, or switzerreport.com.au, and you'll be able to listen to anything we've covered in the webinar, and that'll be up straight away or within about an hour after the presentation. Put the webinar up there so you can go back to it. Okay, let's just, as we always do, just because it is the start of the month, look back in July, back to June, although a lot has happened so far this week, so I feel a bit, we've sort of passed it, but June, the market up 2.5%. We're still down for the year 10.4%, Tony, but interesting there, the bit better performance of the top 20 stocks. They sort of outperformed in the month. They've been a little weaker during the year. Where most of the action, the weakness has actually been stocks ranked about 20 through to 50, because that's underperformed. The mid caps, which are the sort of the stocks ranked 50 to 100, they've actually outperformed. You got any sort of comments about why that's the case, Tony?
Well, I think in terms of the top 20, we've seen a bit of a rally in the banks off their lows, so that would account for that. In terms of the mid-cap 50, we tend to find more of the tech-type names in there, and tech has been doing really well. So I would put a lot of that down to investor interest in some of these big tech names.
And where's Afterpay now? Is that? I think that's technically still in the mid caps. Although it really by market cap should be a lot lower. Is that correct?
I think I'm not entirely sure, Paul, but it'd certainly be pushing the large caps now, the top 50. That's for sure. I mean, it's a pretty big stock these days.
Okay. I see that, Peter, you've joined us all the way from the very cool temperate Blackheath in the Blue Mountains of New South Wales.
That's right. I was a victim of a couple of car accidents along the way, Paul, and that slowed me up. But I think you probably predicted there'd be some kind of calamity along the way, didn't you?
I was very confident, Peter, you'd be there on time, but that's good that you're there, and welcome to the webinar. Okay, let's keep moving. We'll just go to the sectors. I think there's some more stories than this just to talk about briefly. We've got June and then year to date. So clearly year to date, this is the period from obviously January through to June, the IT sector up 12.3%. And healthcare also in the green, and consumer staples, that's largely Woolworths and your Coles and to some extent A2 Milk, that's also in the green. Every other sector in the red. The ones that are really struggling, the sector doing the worst apart from energy is real estate. So that's your real estate investment trusts. And financials are still struggling at down almost 19%, but did a little better in June. So really a tale of two parts of the market, Tony, isn't it?
It is, Paul. Let's not forget when we're looking at the ASX 200 that about 40% of it is weighted in financials and materials. So those two sectors have such a bearing on the index. But it really is a tale of two markets, and I think we really need those banks to keep rising for this market to go higher.
And on banks, how do you see banks at the moment?
Well, as you know, I was quite bullish on banks a few months ago and came out with that call in the newsletter that I thought it was the best buying opportunity in banks in years. Now, they have had a rise since then. I still like banks. It depends on I hate to answer questions with it depends, but it really does depend on your time frame. If you've got a 3-year time frame, I like banks. I think they look really good. If you've got a 6 to 12 month time frame, I think it looks pretty tricky still, certainly with this risk of loan defaults and impairments. That's the big one. I was talking to an ex-banker the other day who was just saying the risk of impairments and small businesses not being able to repay their loans is very, very high and getting higher. So that's something to watch, but on a 3-year time frame, yes, I still like the banks.
Peter, what sayeth you about banks and what we've seen on the sectors?
Yeah, I think Tony's assessment's pretty well right. I must admit, I did laugh a little bit when he talked about his banker friend being worried about business loans because, you know, banks have been criticised for not lending to businesses in recent years, and that's why companies that like Prosper and Latitude and OnDeck, they all come along. And probably the level of exposure the banks would be to better businesses rather than more vulnerable businesses. So maybe those kinds of lenders may well be more exposed than the banks. But I'm with him. You know, I think it's always, if you look at that chart of yours, Paul, and it's a very instructive chart. If you were a contrarian investor, you would be looking at real estate investment and trusts and banks, and thinking to yourself, let's pick the quality ones and the ones that, you know, really aren't terribly exposed to, you know, being crushed by, you know, rental holidays and things like that. Some of these companies are going to do very well over the next 2 or 3 years, and that's what we should be investing for.
Yeah, I think the real estate one's interesting. I sort of did like your suggestions a couple of weeks ago, Tony, about some of the shopping centre trusts. I think you nominated Vicinity as being one, as your preferred one. And I forget who the second was, but they were obviously, these are sort of the super centres. And when I say super centres, the prime places like Chadstone, Victoria. I think it was Vicinity and
Charter Hall Retail REIT. That's an interesting one as well. But I think, Paul, to your point, the real estate property, I break it into 3 parts. The fortress malls at the top, so the Chadstones, the Westfield Bondis, I think they're fabulous assets. They've got challenges, but they're very, very hard assets to replicate. At the other end, you've got the suburban neighbourhood shopping centres. So that's where you've got a Woolies and maybe, you know, a Butcher Baker. That's half a dozen shops. I think they look okay, but the ones in the middle, those mid-ranking shopping centres, I wouldn't go near. I think they've got massive problems. Yeah. But so if you're going to buy retail property, stick to the absolute fortress mall owners.
What about on the commercial side? Because I think the jury's I just can't get a handle on just how bad that's going to be. I've been surprised as someone who's been coming into the city right through the lockdown, because we decided that our business would operate best that way. I've been surprised how slow it has been to recover, how people to come back, and I'm just not convinced that office stuff is going to come back. I'm just very worried about that sector. So, what do you have any sort of take on that?
I'm avoiding commercial property, Paul. I'm with you. I just think it's going to take a long time to come back. Look, I have fears it'll never be the same again. I know, it's risky to say never say never, but every second person I talk to says they're probably going to work a day a week at home from now on permanently, or 2 days a week, or all of that equates to less office space. So I think there's some real disruption ahead for the commercial property sector.
Any thoughts from you, Peter?
Yeah, I think you have to get really granular when you're looking at real estate investment trust, Paul. And I do think some commercial-oriented real estate investment trusts will do okay, provided they've got big tenants. The ones that got a lot of small tenants, they're going to be in trouble, I think, in the short term because of the rental holidays and whatever. If the turnover is over 50 million, of course, there are no rental concessions and whatever. And particularly those ones who've got government tenants, they're the ones that I would be prepared to have a go at. But if you've got a really diverse kind of smaller tenancy, I think that they are going to be in trouble for sure.
Okay, let's just wrap this up and move on to the next slide. Just resolutions for the new financial year. I might throw to you first, Tony.
Resolution to the new financial year. Well, I have two. So the first one is to really be patient, because I think if we just set a bit of a map for the next, say, 4 to 6 months, Paul and Pete. So you think right now we're embarking on confession season, where the companies will come out and start downgrading. Then we've got in August, we've got the full year profit season. September, we've got JobKeeper, JobSeeker, mortgage deferrals, rental relief, possibly all coming off at once. October, November, we've got the AGM starting, so we'll get the first quarter trading updates. US presidential elections, coronavirus. I could keep going, but my point is there's going to be a lot more volatility in the next 4 to 6 months. And I think there's going to be some really good opportunities to buy stocks at lower prices. So when I say patient, that's not, I think a lot of investors are either all in or all out. What I'm saying is make sure you've got some cash on the sidelines. Don't go all in. Just buy on those big down days, those big down periods when volatility is high. And also, in terms of patience, don't try and buy stocks when they're hurtling lower. Just wait for them to form a base. It's better to miss out on a bit of that recovery on the way up, I think, than chasing things lower and catching a falling knife, as they say. So that's resolution one, have some cash and be patient. Resolution two, to sort of extrapolate on Pete's point just then, stick to quality. It's so important to invest in good quality stocks at all times, but particularly now. And when I talk about quality, I'm looking at things like high return on equity, strong balance sheet, low debt, and more importantly, or as importantly, what's unique about this business? What's hard to replicate? So we mentioned before retail property, very hard to replicate a Westfield Bondi or something like that, or pricing power, or a sticky business model. So something like a Xero, the accounting software company, which I liked and still like, that's really sticky, because once you start using this damn software, you can't get off it because it's so tricky. So my two resolutions, patience, quality.
Okay. Peter, can you add or enhance, add a third to those? What do you
they're good resolutions.
Yeah.
But they're really what, I always do, Paul, and I probably learned it from, great business minds like Tony Featherstone when he was a young man heading up BRW, and I was just a humble economist, But my resolution, look, Paul, what the way I invest. As far as I'm concerned, you know, I wrote a piece on Monday, and I've been wrong ever since Monday. 10 reasons why the market should go down. The market's gone up, but I think all those 10 reasons will eventually create another buying opportunity. And so the theme I'm taking into this new financial year is ready, steady, buy. And that's what I'm going to be doing. And exactly what Tony said, when quality companies are at really good prices, I'm going to keep adding to the company. I think that's going to be my resolution this year. Just get ready for those opportunities to buy and buy quality.
Okay, all right. Well, look, I can't top any of that, and I know that you would have said quality anyhow. So that's why I thought whether you might how you'd go adding to that. So thanks for that. Okay, let's go to some questions. We've got a lot we had beforehand, and some that we've come in. We'll just theme this a little bit. Let's just talk about the market overall. So the first couple of questions are around, can anyone believe what's going on in the US? So this one came from, apologies, I haven't pronounced this correctly, Slobodan, and says, do you believe that a correction is due in the near future as the US stock market valuation overall seems extremely unrealistic? So there's a chart of the S&P 500. We're not too far off our all-time high, and if we put the Nasdaq up there, we'd be at the all-time high. I'll throw that one to you first of all, Peter. What do you think about the US, and can you believe why they keep buying it every day?
No, I can't. That story of mine on Monday was basically on the basis they're 7 or 8% off their high, and they've gone higher this week. Nasdaq's up 5% this week. But I tell you what, there's going to be an opportunity. They'll definitely retrace a fair bit. I think 7 or 8% wouldn't surprise me whatsoever. But the thing is this: Wall Street is betting that there's going to be a vaccine found before the US election. And Goldman Sachs had a health conference only a week or so ago, and the takeaway message was that most of the executives from big Wall Street investment firms are betting that 2 vaccines could bob up before the US election. And that's what's in there. Now, if the vaccine timeline ends up being wrong, there will be a sell-off. And but I can't believe it. Slobodan's right. I can't believe what's going on right now.
How about you, Tony?
I'm with Pete and Slobodan on this one. I think the US market, I wouldn't be going near US equities right now. I think it's run too far, too fast. We're seeing daily cases of 50,000 coronavirus, and the chief medical officer saying that could quickly get up to 100,000. Now that's a lot more significant than we thought. Just if I can add to Pete's point, I get what you're saying, Pete, about vaccines and betting on it and US presidential elections and all of this, but let's face it, there's only one thing and one thing only driving US equity prices, and that's the US Fed. And that's what people are betting on, that we've got interest rates near zero, we've got US Fed backstopping corporate debt, we've just got this incredible liquidity. And it's the old saying, don't fight the Fed. Now, I'm not saying that's right or wrong, but what I'm saying is it's entirely plausible that risk assets keep rising when you've got the Fed just pumping so much liquidity into the market. Now, eventually that party will end and could end quite abruptly, and I think it will. But that's really what's driving the market. So you've just got to keep watching that Fed and keep watching those central banks.
Okay, another question. If we do get a pullback in the US, I know you're more focused in Australia, but just what US stocks would be the ones you'd be potentially having a look at?
Well, the first sector I would go to would be the FANGs. I'd be looking at the big tech stocks. Now, I know they've had a big rally and the Nasdaq's at the high, but when the coronavirus first erupted, for the Switzer report, my very first column in, I think it was late February, early March, said buy tech. And then I think my next 4 columns after that in the Switzer report said buy tech. And the reason I said buy tech is that if you look at other crises like SARS, the 2000 and when was that? Whenever that was, the SARS crisis, tech was the best performing sector a year after that. So that's what I'd be going to, the big names. And yes, they're pricey, but they are pricey for a reason. They're astonishingly good companies. I also like things like Disney. I think Disney's a great company and so much demand for content with people at home and so on. I like McDonald's. I think McDonald's is a really defensive stock, a more defensive stock than people realise. And I think, so I'd probably be saying the FANGs, Disney, McDonald's, stocks like that.
Okay, Peter?
Well, I think I was going to say a lot of what Tony said, but last night, Paul, I just had a quick look at WCMQ, which is a company that we have an indirect relationship with. We, basically Contango, which we have a share in, brought them to Australia. And I looked at their chart over the last 6 months of last year. These guys are actually above where it was before the crash. And so I'm thinking, I'm not an expert on foreign companies, but guys like them, and of course Hamish Douglas at Magellan, and for our financial planning clients, we've put them into Magellan and WCMQ or WQG, and they're really smart guys. So if the market sold off, I want to be with the smartest people around, picking the companies that have been ridiculously smashed because everyone's panicking.
Okay. So that's WQG and MGE from Magellan, right?
Yeah, exactly.
Yeah. Okay.
Yeah, that's a really good point, Pete. If I could add to that too, some of these global LICs from good quality names, the Platinums and the so on, are trading at pretty big discounts. So, if the market falls, you're buying at a discount into the market at another discount through some of these global LICs. So they're worth a look.
Okay, I just want to get off a couple of the questions here. One from Tony about where's the bond market headed. I guess you can break that in the Australian US bond market, but interest rates and bonds, they're not going anywhere, right?
Yeah, I would say that they're probably not going anywhere. I think the fact that the Fed has committed to purchasing such a wide range of corporate debt, I think that just, is a pretty important backstop. So, I think it looks okay. Provided the Fed stays there with its unlimited checkbook.
I think the US yield curve will continue to steepen as it will in Australia because they're going to have to issue so many bonds, just supply and demand. But
the only thing I'd say to that, Paul, sorry to talk over you, is there will be credit downgrades coming. That is a certainty. As we start to see the economic damage of coronavirus.
Okay. I want to move on to gold, but just a question for you, Peter, from Russell. If there are, it says, if there are many new share traders since COVID-19, how are they perceived to be affecting share prices?
Well, I think he's asking the question, have the newcomers to the market pushed share prices up? I think the answer is yes. I think a lot of younger people, they can't raise money through term deposits to build up their deposit for a home. Home prices are unbelievably high. This is a younger cohort who've been brought up with financial information and education from a very early age. Most of these guys would have grown up at a time when the Money Program on Channel 9 was one of the top rating shows. People like myself and Tony and David Koch and Ross Green would have been educating people for ages on television and radio. This is a really savvy group of people who have actually realised that this is a buying opportunity for them. And I think they've gone into the market and they're buying stocks. And I think they've probably pushed up share prices higher than they should be because we've just got basically new players in the market. What do you think, Tony?
I have to respectfully disagree with you on that one, Pete. I think if you look at something like a Robinhood, I read the other day Robinhood has, which is this new online platform, online trading thing that all these younger people are using. It has twice as many users as E-Trade, so about 10 million apparently. But the big difference is the average balance I read is 1,000 to 5,000. So it's young people trading tiny amounts of money, speculating. So whilst I think that could be affecting some of the smaller specky stocks, fintechs, things like that some of these millennial investors are familiar with, and tech, the reality is the market's driven by instos mostly. So I think it will have some impact around the margin, but not overall. But I do, Pete, agree with you that the younger investors are just so savvy these days. So, and I hope they do get into the market. to draw on your point about house prices and so on, because that's the way to build long-term wealth.
Okay, I want to move on to some questions on gold, then I'll come to some questions just come in. So question from Jeff and Simon, and also I guess Esni Mahmood about gold. Are you a gold bull, Tony?
I'm not a gold bull. I have been. I'm not so much of a gold bull now, but I'm not a gold bear either. Sorry to sit on the fence. I think that the risk to gold from now is probably to the upside. So I think Aussie dollar gold can probably go a bit higher from here. I don't think it's going to shoot higher from here, but I certainly wouldn't be selling gold now if I had a gold ETF, gold bullion. I think one of the big issues is coming into this US presidential election. If we see US dollar weakness and the US dollar unravel a little bit, that could be good for Aussie dollar gold. So I think there's a few tailwinds ahead for gold, not to mention all this volatility and the uncertainty of coronavirus and the fact that gold is a traditional safe haven. So I wouldn't be rushing out to buy gold, but I certainly wouldn't be selling it either because it's probably heading a bit higher.
Okay, Pete, on gold?
Well, I think, Paul, you and I talked about gold about a year ago, didn't we?
We talk about it every photo, I think, Peter.
Yeah, but I think we actually did a spot for net trade on GOLD and whatever. And it's been a nice upside since then. I don't think there's much more upside unless some really bad news comes along. I don't think we're going to see rapid inflation, for a couple of years at least. So I think I wouldn't be selling off. I agree with Tony, but I also wouldn't be piling into it now. I think better quality companies that will give you a much better return and are more reliable and will also give you income as well. So that's my view on gold.
Okay, so North Star Gold, are you familiar with the NST? Tony, do you have a view on this? A question from Douglas?
Yes, I have written positively about NST in the past, Northern Star for Switzer Report. Not for a while, but it was one of the gold stocks I wrote favourably about a while back. I think it depends on where you bought it. Its third quarter production was a bit below forecast. And the brokers I follow that look at Northern Star say have a target price about $14. So it's probably about fair value, I would think. But good company, good assets. Again, I wouldn't be selling. I wouldn't be buying either in a hurry right now.
Okay, all right. We'll move on to some tech and payment questions. We've got a few here. So I think we're going to unsurprisingly, question on Afterpay. So we'll just try you. I'm just looking at the hand. What does that mean? Oh, okay. What is it? You can that's not an unmute. Okay. So question from Shuhei and also James. So do you, Tony, Afterpay? Have you been on the Afterpay train?
No, I haven't. I have to admit I missed that one. And I'm kicking myself because I always think the best tools are your eyes and ears for investing. And I remember looking at Afterpay when it floated and seeing little Afterpay stickers on all these retailers who were using Afterpay thinking this thing's taking off. Look, it is a great company, no doubt about that in terms of it's what it's doing in this buy now, pay later. Very valuable first mover advantage, but it's just, I just can't get my head around the valuation. And I think the big issue now is that the typical users of Afterpay, younger people, are most vulnerable to job losses in this coronavirus. I think we're going to see a lot more bad debt level, rising bad debts amongst that cohort, sadly. Younger people out of work, sadly. So I think there's a real test coming for Afterpay. Not to say it won't get through it, but I just think with the valuation where it is, I just prefer to wait and buy it at lower prices.
Yeah, I think a lot of the momentum is partly people trading it, but also I think a lot of the institutions are now being forced to buy it simply because it's coming such a weight in indices. So you got to be a little bit careful of that. I mean, if you got it, I reckon you hang on because the let your profits run. But if you're going to buy, I think you got to be prepared to turn that over fairly quickly. Peter, you missed like me the Afterpay train, didn't you?
Yeah. And the fact I taught Anthony Eisen is something I can never forget as well. He's a founder. But the time to buy it was March 23.
Yeah.
It was a good company, and you could have got what $10 around that time. That was the time to buy it. Tencent has got into it and really turbocharged it. And I think maybe if there is another big sell-off, that'd be a company I would be happy to buy at a lower level, but not this level.
Yeah, it just reminds me a little bit like a Poseidon, but anyhow, you know, it's sort of you see that graph every day. I mean, they're not. It's not a unique business model. So just while they've got lots of share, you've got to remember most of Afterpay's money comes out of the margin it makes from the merchant, about 4%. I think it's very vulnerable. I always have to that being squeezed. Doesn't make it out from the consumer; it makes it from the business. But I reckon at the moment the reason it's got the upsend is because there's nothing else to buy it for following the US IT trend, and some of our institutions are being forced to buy it because they underweight it. But they can change their mind fairly quickly. Okay, what about Split It, SPT? That did a deal with I think Visa or Mastercard to sell its stuff. It's also had a good run. Thoughts on Split It? There's a couple of questions. One from Sarah, one from Mario.
I don't cover that one in detail, Paul, so I'd just be guessing. So I'll hand that one to you and Pete.
Okay. Pete, you want to talk about Split It?
I don't know enough about it, Paul. I know it's been a new darling on the market. And I guess if you look at the history of new darlings, well, the history of new darlings is not reliable. Was a company called Blue Sky once upon a time that was a darling, wasn't it?
Yeah, there are lots of darlings.
Yeah, lots of darlings. So, look, I think it looks like the kind of business young people will like. You know, they like to go out to dinner and split the bill and all that sort of stuff, and it's an app to do that. But I just can't see it being as I don't see it as a new Afterpay at this point in time.
Okay, let's move on to is Alex? No, or Craig? Alex. Okay. Alan, sorry. Alex, we're just about to unmute you because you're currently showing as being on mute. You've got to unmute yourself. No? No? No go? You there, Alex? It's Alex B. You can talk. We're not hearing you. You're showing our screen as being unmuted. Okay, we'll move on to, now maybe we'll have to dismiss that. Let's go, Alex, let's go on back to, try to Alex again or not? No? Okay, let's go to Craig. Okay, Craig, can you talk to us?
Yeah, you got.
Yep, we can hear you. Thanks, yep.
Just Technology One, TNE. The analysts from FN Arena don't really speak highly about it, yet Rudy from FN Arena quite likes it. I just want to get the opinion of you guys.
Okay, is it a company, Tony, that you're fond of?
I like Technology One. I think it's been a very high quality for a long time. I remember meeting Technology One management many, many years ago when the company kicked off. I like IT service providers now because I know some people who work at tech companies, the service providers, who are telling me they're having record months because of just the disruption of coronavirus. Is creating all this extra work in new IT systems and so on. I like Technology One's sector exposure. It's got good quality clients. I haven't done enough work on its valuation, but it's funny the reader mentioned. Sorry, I missed the reader's name, but it's funny the reader mentioned Technology One because I'm thinking about writing on these IT service providers for an upcoming column for your report. The Switzer report, because I think they look pretty good or starting to look interesting. So I'll be doing more work on Tech One in coming weeks. Okay,
that sounds like that's a bit of a positive, I think, to answer that question. Okay, question here from Matthew about EML. I know that's stock you've been interested in. Peter, should I buy more from here or hold my position?
Yeah, I must admit, I haven't looked at it lately. Can we pull the chart?
Bring that up.
I've certainly... See, remember, EML is going to do better when casinos are open and shopping malls are back to normal and whatever. So the fact it's bounced back to the current level makes me think there is more upside as we embrace normalcy. Now, if a bit of momentum has been taken out, it's because of the state where Tony Featherstone comes from. We'll hold him personally responsible for Victoria's failure kill the coronavirus.
I'm the super spreader. No.
And I noticed that your suburb was free, mate. So I'm glad we wouldn't have let you on the Zoom if you.
Yeah. Hopefully, we'll still be free on the weekend. Who knows in the People's Republic of Victoria.
But I think EML has that future when we get into more normal times. And remember, the Spanish flu hung around for about 2 or 3 years. But from what I've seen on EML, I bought it at lower levels, of course. But I'm happy to hold, and I wouldn't be afraid to add to it here. But I think the upside's there for sure.
Okay. What about Iris? Is that a company? It's a question from Mike. Tony, do you have a view on Iris?
Yeah, I have covered Iris a lot over the years. I haven't looked at it for a while, but again, very high quality data is a really, really good business. My only concern is the end users of that data in the advice market, given the number of people leaving that industry and what that's going to do for demand. So I wouldn't be in a rush to sell Iris. I wouldn't be in a rush to buy it either at these levels.
As given its position last year, it really hasn't come back much, has it? I mean, if you look at other, Iris was a tech darling.
Yeah.
And it started off providing software or screens that traders use, and then it moved into basically sort of taking over the financial planning software. Bought a company called Xplan in Australia and a whole lot of things in South Africa, and it's somewhat sort of struggled a bit since then because some of that software is pretty ordinary. But yeah.
And the ASX is no longer a shareholder, is it? It's my understanding.
I think they got out. So it's one, maybe if you're looking at software services, because it really is software as a service, I think that company is, that's one to look at it. So so it certainly hasn't done as well as some of the other tech companies. What about Altium? Question from Rob.
I really like it. That was one of the stocks I was positive on. I said earlier that when the markets fell in March and I said buy tech, that was one of the ones. And it's had a really good run since that idea. I just am such a big believer in this whole Internet of Things and connected devices and so on. And so having the electronic circuit board software and so on is such a growth market to me. So yes, that would be certainly one of the first so-called wax stocks I would buy on any sell-off.
Okay, all right. Peter, you want to talk on Altium? Or?
I hold Altium. I'm a holder. If it dipped, I'd be a buyer.
Okay. All right, let's go to another question here from, I think, is it Matthew at the top there? No? Rami, I think. Hopefully, my apologies if we've got that name wrong. I'm struggling to read it on the screen. So, are you there, Rami?
Yes, I am. Can you hear me?
Yeah, we can hear you fine. That's good.
Yes, hi. Thank you so much for having me. I just have a question regarding Ramsay Health Care. The non-essential surgeries has been released and has been eased, but Ramsay Health Care hasn't been doing much whatsoever. Is there a reason for that?
Look, it raised capital at $56 and it's now at $67. So it did a fairly dilutive capital raising. I think it took $1.2 billion in. You've also got to bear in mind the Aussie dollar's been going up. So it's got a fair bit of revenue coming out of both France and the UK. And I think the return back to private hospitals in Australia has been perhaps slower than people expected. So I think it's just got healthcare sort of not been a bit on the out of favour the last couple of months. Tony, do you want to perhaps?
I would agree with everything you said then, Paul. It has been a bit out of favour. And I do think that this downturn in the hospitals with the essential surgeries has affected it. But then, non-essential, sorry, but then there is a big backlog of those surgeries ahead. So I can't see Ramsay really taking off in this market, but it's a really good quality company. So I think it's just one for the portfolio for the long term, but I don't see any urgent need to buy it right now. Okay.
Peter, you want to comment on that and we'll move on? No?
I wouldn't sell it. I'm holding it. And I think, remember, they earn a lot of money overseas nowadays. And there's so many question marks over what's going on overseas. and I do believe that there, a lot of elective surgery and there's going to be backlog. I think they'll come good over time, and the chart, is not a negative sign to me. I just think if you don't hold it, it would be nice to buy it at slightly lower levels, but I think it's going to be a quality company going forward. Its share price will reflect it.
Okay, question from Denise on Transurban. You a buyer of Transurban at these levels, Peter?
I must admit, I've stopped looking at Transurban. I'm not quite sure if I'm a buyer at these levels. Let me, this is what the analysts are telling me.
Just while you're going to the analyst, Tony, any views on Transurban?
I like Transurban. Again, I was quite positive on Transurban and Atlas Arteria a few months ago. They've had a big run since then, so I wouldn't be rushing in to buy them now. But I like the toll road operators. I just think that one of the big changes coming out of coronavirus is going to be more traffic congestion because people are going to be wary of public transport for some time. Not all people, of course. And we're seeing that already in Melbourne. I'm just surprised at how quickly the freeways are filling up again. So I like the toll road stocks. I like the fact that they're monopoly infrastructure assets. I think interest rate sensitive stocks, and you could add Sydney Airport into that with interest rates where they are, I think look pretty good. So I certainly wouldn't be selling Transurban right now.
Paul, the analysts say 7% down, and that's why I hesitated because, I knew, I read Tony's article and gave myself some exposure to it, but I knew it had been rising, and it's probably at the right level now.
Yeah.
So it's a great company to buy if there is a dip, and also if there's rotation out of it. And often good companies suffer from rotations, that they're chasing another sector. We've seen it with CSL recently. It dropped purely because other sectors were being chased. That's a great opportunity to buy those sorts of companies, I reckon.
Yeah, that's spot on. That's exactly how I feel about it too, Pete. So I would certainly buy it at lower prices, but I'd be holding it around here.
Yeah. Okay, let's go to a question from, is it Laurie? Yep. Laurie, can you go ahead?
Yeah, g'day. It's Craig, her husband here, actually. It's all right. I just wanted your thoughts on Sky City Entertainment, please. Thanks, guys.
That's SKT from, or SKY, Sky City Entertainment. I did read something positive about that yesterday, so.
Yeah, there's often a lot of analysts that like Sky City.
That's the New Zealand company, isn't it, from memory, right?
Yeah, that's the casino operator with the Auckland and
it's got rivals, and eventually, when it's basically going to get New Zealand's going to have to wait until people can fly in there, aren't they? And so you're buying at a good level, but you might have to wait 6 to 9 months to see some really big returns.
And it has had that recapitalisation, hasn't it, Sky City? So I think its balance sheet is looking better. I'm kicking myself because I did a big story for the Switzer Report on casino stocks recently, and my favoured one was the Star Entertainment Group, which has the Star in Sydney and the assets in Brisbane and the Gold Coast. And what I found interesting with the Star is that if you look at Sky City, that their some of their electronic gaming volumes have come back quite sharply. So what that means is people are back playing the pokies. So I think Sky City is definitely worth a bit more of a look.
Yeah, I'm looking at that chart up for Star Entertainment. It's had a big bounce actually from under $2 to over $3. So at 152 it touched, I think, from the.
Yeah, and if we do this Trans-Tasman travel bubble, if that was to happen by the end of the year, and we've got Aussie tourists going to Auckland and so on, that'll be good for Sky City.
And we will go there in big numbers.
Okay.
And gamble.
All right, let me move on to a few more questions. We'll just a quick question from Mark. Do coal stocks have a future, particularly Bathurst Resources? So we did that big special on coal stocks on Monday, I think it was. What's your view on coal stocks, Tony?
I haven't had a good look at Bathurst Resources. I've had a look at some of them like Whitehaven and so on, and they look undervalued to me. I think it depends on your. I think it depends on your view on coal and climate change and so on, but I think they have a future. I think they've fallen too far. I was having a good look at Whitehaven this morning in response to a reader question.
WHC, yep, we'll just bring that up.
Yeah, and I just think, I saw some broker targets quite higher than where the stock is now, so I wouldn't be giving up on coal in a hurry.
That's a question also from Sonia. I think I mean, the thermal coal price has come under a lot of pressure. I'm not sure what's going on. I guess it's a lot of people producing, so that's why Whitehaven Coal and others have come down. I guess the way I look at it is I think the trend is inevitable that fewer and fewer institutions are going to buy them. So while they're cheap, you can't. The forces out there are too strong. So I'm cautious. I don't think I'd be touching buying coal stocks, but
Paul, the analyst thinks 61% upside, but that has all the issues built in that you've been referring to. There is a swing away from them because ethical investing. I've got to say, I've got to go on the lookout for the best ethical investment fund that's listed because the world is heading in that direction.
Yeah.
And so
it's a mega trend you can't stand in the way of, I think.
Yeah.
Okay. Ed's got a question here about the ASX stock FANG. Ed, I wrote about that a couple of months ago. I think from memory, FANG's got 10 stocks. So it's not just your Facebook, Alphabet, Netflix, and Google, effectively through Alphabet. There's also a couple of others. So it's an equally weighted ETF. Also, I think includes Baidu and Tencent. So one way to play the US market, but it's not just the FANG stocks. I think that's the first thing to appreciate. Have you had a look at the FANG ETF at all, Tony?
I have, and as I said earlier, if there was a big sell-off in the US, I'd be buying FANGs, and that's an easy way to do it. The only thing I'd say with some of these global tech stocks is just be mindful of the currency because there's a whole overlay of currency risk as well. So you need a view on the currency, but I think it's an interesting idea for an ETF. Obviously, concentration risk, so it's not your typical ETF with dozens and dozens of stocks. But that can be a good thing too if your idea goes in the right direction.
Okay, I've got a question in from Robert, I think. Yeah, we should be able to hear you, Robert.
Yes, a bit more of a big picture question. The PM gave the defence update yesterday, and they're spending 270 billion over the next 10 years. And they're also questioning China's getting more aggressive and so on. So my question is really, have you taken much note of that, and are you positioning for that potentiality of a conflict, and any views on defence stocks?
Yeah, so Peter, I hope you could hear that question that was around the $270 billion, our rhetoric with China, the big increase or allegedly big increase in defence spending. Is that changing your view, the long-term view about investing, and are there any defence companies? So that was sort of the substance of the question, if I'm paraphrasing that right, Peter.
I heard it, Robert. It's a really
Robert, sorry.
Yeah, Robert was the question. It's a really good question, and it's just a good question. I think I'll get Tony Featherstone to actually answer it. It's a really hard question to answer because what are we going to say? Australia, China gets into such a political blue that China stops buying our exports. Possible. Hopefully not. China does rely on us pretty heavily, but I guess they could punish us. They did it with barley. But at this point in time, I'm kind of keeping my fingers crossed like a Pollyanna and hoping it doesn't get to that.
Yeah, look, it's a fantastic question. I think it's not a huge investment issue on my radar right now. Not that it's not valid or important. I just think there's bigger issues right now for the markets in terms of corporate earnings and the coronavirus and so on. We've had geopolitical tension with China rising for some time, which is being priced into certain stocks. That's something to watch, but I don't, and we don't have a lot of defence stocks in Australia. I mean, there's some really good ones like Austal, of course, the shipbuilder, but so it's not something I'm paying a huge amount of attention to from a investing perspective right now.
And Paul, quickly, despite China makes a lot of loud noises, they are heavily invested in the Western world economy. And I think they're probably hoping that Donald Trump gets beaten at the next election. I think there's a bit of ducks and drakes going on with China as well. They do not want to undermine the global economy because America's heavily in debt to China.
Okay, we'll move on. Thanks, Peter. Question from Peter and also Helen about FlexiGroup. Always get asked questions about FlexiGroup. I don't understand why, but I know I've got an opinion, but they've come up a bit. Tony, what you got an opinion on?
I haven't covered it in detail, so I'll leave it to you, Paul.
Right, Peter, do you want to? You used to know a lot about FlexiGroup.
Yeah, well, I used to know the CEO very well, but he didn't last very long, there. And look, Paul, we asked this question probably in our Boom Doom Zoom show, and we came up with the same conclusion then, that this is not a company that you really want to be exposed to. They're trying to play catch up with Afterpay and Zip, and the analysts got a 2% downside for it. There's just too many better companies than FlexiGroup as far as I'm concerned.
Okay, question from Wendy. If we go to Wendy. Okay, Wendy, you're going to have to unmute. Okay, we don't seem that's still showing as muted, so we'll go to Sherbinez. Okay, Sherbinez, yep, you should be right.
She's an expert.
Hi. My question is.
Well, we're just having. You started talking, Sherbinez. Just. I think we've lost Sherbinez. We want to go back to Wendy again, or we'll try Wendy again. Okay, Wendy, you have to unmute. Okay, all right, well, let's go to a couple others we've got here. Okay, a question from Mark. What's happened to Adelaide Brighton today, and are they a buy at these prices? I haven't seen Adelaide Brighton today. That's code AB. Adelaide Brighton is AD. Tony, you on top of Adelaide Brighton?
I haven't looked at it today.
I'll just try to get Adelaide Brighton up. It's been a very disappointing company, Adelaide Brighton, and I remember getting a little bullish about Adelaide Brighton and making a big mistake on this about 12 months ago. I just can't think of the code. So ABC, isn't it? Yeah, is that right? That sounds familiar.
No. Oh, yes, it is. It is. Adbri Limited, you're right. Yeah. ABC. And the analysts have 13.9% upside. I don't know what's happened to it today.
So they have a contract update today. Contract update for.
What's the code, Peter? Have you got it there?
It is ABC. Adbri Limited.
Yeah, it's changed its
So
name.
it lost a $70 million contract today.
Yeah.
It's down
the line supply.
Down 24%, is it?
Yeah, I made a big mistake of recommending them about 12 months ago, and they have. I think they're been a little bit of a dog. So I don't think they're the building company you look to anymore. I think they used to have a pretty good operation, but I think the lime business has been particularly problematic for them. Okay, so that explains Adelaide Brighton. Okay. Another question from Joe about Zip Money, Z1P. Do you follow Zip Money? We see a lot of Zip because they're in our building, Peter. So
yeah, the analysts have about 13% upside. Look, I think they're a steady pair of hands in this game. Afterpay shoots the lights out. Zip is the second player in the market. It's always had a better approach to granting credit, which I always thought meant that it would have solidity in the market. It's had a nice rise. Like I interviewed them about a year ago, and they were $1.20 or something like that, and whether they're at $5.64. They've done really nicely. I think they'll be a steady pair of hands, and they'll do well. But I don't think they'll be an Afterpay, but I don't think they'll be a bad company either.
Yeah, I would agree with Pete on that. Steady pair of hands, good company. And the thing I would say in these new markets like buy now, pay later, or any new market, it's often the second player in the long run that can do really well. I mean, look at Apple over the years. Apple was never the first player in a lot of devices. It was the second, even the third player, and it waited till all the people in front made the mistakes, and it fixed those mistakes and did really well. So yeah, I like Zip as well.
And Paul, can I quickly tell you one thing?
Yep.
Because Zip is in our building, we're seeing how many parking spaces they're taking. and I drove into my parking space today, and there was a Zip Money sign on my parking spot. So we have to take that up with the management, but they are expanding.
Tell them to zip off. Yeah.
Okay. All right. Look, I won't throw this over to you. There's a question. Is there from, I think it's Ang, is there an ETF solely for world airline shares or an ETF for cruise ship shares? There's certainly not one in Australia. There may be one listed in the States. I'm not familiar with either of those two. So we'll say that.
There would be. There's an ETF for everything in the US.
So you have to look at, go to NavTrade or ComSec and try to find an ETF that's available for their platform. A question here on, I want to just throw to you, Peter, from Bob, the future dividend payments on the big four banks. What do you think is going to happen with dividends on the banks? And I'll throw that to you as well, Tony.
Yeah. 3 months ago, I think the views were terrible. I think they might end up being a little bit better than we expected because I think the economy is going to come back better than the worst case scenario. But if Tony's banker friend is right, maybe the banks will find it hard to reboot the dividends. I don't think we'll get back to what we had before the coronavirus for about 2 or 3 years. But I do think that the worst case scenario, like dividend deferrals and stuff like that, they'll have to be re-looked at if our economy does bounce back a bit faster than what people expected. So I've got confidence dividends will come back, but they won't come back to the same level for a couple of years.
Tony?
Yeah, well, Pete, that's exactly how I see it as well. That I've written that in your report that I think it could be 2 to 3 years before bank dividends get back to where they were. Is the worst over now for bank dividends in terms of cuts? I think probably yes, because I too, like you, think that in 12 to 18 months our economy will be a lot stronger. But I wouldn't be expecting any big joy in bank dividends for some time.
Okay. 2 questions to conclude. Aristocrat Leisure, is that a stock that you follow, Tony?
No, I haven't looked at it for some time, Paul.
Okay. It's in my portfolios. I quite like Aristocrat Leisure. It's obviously exposed to the world gaming market, but I reckon it's a pretty good performer. So I think that's a stock you can see the funds are buying when they get dips as growth stocks. And then a question here from Joe, looking at WAM as a safe haven for income and franking, any thoughts? I know I've got some thoughts on that, but I might just ask you whether you've got any thoughts on that, Tony.
No, I haven't. I'd have to do a bit of research on WAM. I don't know where it's it's normally at a premium, isn't it? I don't know where it's at the moment. So, and I've got to say, LICs, whilst I said some of the global ones look cheap, there are issues with LICs, I think.
Yeah, I never understand why you want to pay a premium for something. I can't get that. And if you look at that stock, it's done absolutely nothing now over a couple of years. There are other ways you can get dividends and income. So I wouldn't touch it, but that's not to say they're not good managers, but it's just, I'm not sure why you buy something at a premium, Joe. So that's up to you.
Paul, I did ask Jeff if he put his daughter into WAM. He actually said no, because it's trading at a premium. He said, I'd put it into something that's trading at a discount in the Wilson stable.
Yeah. So look, that's about as much as we've got time for. I think, do we have any just, we didn't, just try Sherbinez for the last question. If you can unmute, and we didn't hear you last time, Sherbinez, you cut out. So we'll just give you the question, the last question. You should be able to talk now, Sherbinez.
Hello?
Yeah, just.
Hello?
Yeah, we can just hear you, Sherbinez. So
my question is regarding Jumbo Interactive. And
Jumbo
if you
Interactive,
buy-
yep.
is it a
JIN?
buy or at current prices?
Okay, is it a buy? I know we've had some good comments on Jumbo Interactive in the past. Tony, I don't think it's one you necessarily
Not one I
cover.
cover.
No.
Okay.
Paul, let's say 12% upside, but I'll ask Julia Lee because Julia's watched that over time. So on Monday's show, I'll ask Julia about that stock. And there are a couple other ones that we didn't have answers for, which I'll put the pressure on Julia to find the answers for us.
Okay. Well, look, we're out of time, folks. Sorry we couldn't get to all your questions, but we've covered as many as we can. And we'll be back on Thursday with our Boom, Doom and Zoom webinar, so you get another chance then. Tony, I want to thank you very much for joining our presentation. Some great insights, and I think if there's somebody who really has a view about someone you should follow, I think your views, Tony, are absolutely spot on. I like your idea about both patience and quality as well, so thanks for that. Thanks for joining us.
Thanks, Paul.
Peter, no Wall Street tonight, so they're all gone away for the 4th of July long weekend. I think they're also taking Monday off as well in many parts of the country.
Yeah.
So what are you going to write about tomorrow?
Well, it means that I can actually sleep in tomorrow.
I don't think so.
Yeah,
Just for a change.
I can write the Switzer report tonight because I always hold back to make sure we get on the Wall Street. Yeah, I'm actually going to sleep in. That's going to be the news story for tomorrow. But I'll write tonight, and I'll be trying to work out why my 10 reasons why the market should go down didn't happen.
Okay, well, a bit of a mea culpa. Is that what we're looking forward to tomorrow?
Eventually, I'll be right.
Okay. All right, it's just after 1:30. Thank you so much for joining us. We'll be back, as I said, with our Boom, Doom and Zoom webinar each Thursday, plus our monthly webinar on the first Friday in August. Have a great afternoon, good happy trading, and we'll talk to you next week. Thanks for joining us. Good afternoon.